from Jason. I'll let you guys know in just a second, but welcome everyone. Thank you so much for being here. My name is Alexa, Operations Manager here at BPM RIA, stands for Broward Palm Beach, Miami Real Estate Investors Association, your only local chapter here in South Florida that's partnered with the National Real Estate Investors Association. We have Jason Clark here. He's at Smart Home Loans, one of our long-time corporate members, very loyal. We've known him for a while, and you'll know that from the presentation today, from the talk today. You'll get that vibe from all of us. But a couple upcoming tons of upcoming events for you guys, tons. So I'm going to go ahead and link our website in the chat for you all. You'll see I'm putting a lot of helpful links in the chat throughout the webinar today. Tons of upcoming events, free webinars, all the above, in-person networking, workshops, all of it. So I invite you to go check out the website, register for all the events that you can attend. This one right here in West Palm Beach, we're going to be getting into short-term rentals. We have a few vendors here for networking. This is limited seating. So right here, October 27th, if you can make this event, please RSVP. If you can't, I'm sorry, but you do have another opportunity the following week. Plenty of networking. We're going to be at our usual spot, the Signature Grand in Davie. Jason will be there, God willing, and we're gonna get into a whole entire education portion in the second half with Andy Heller, who I am introducing to you guys, if you haven't already met him, very soon, so you can get ready for that. And then we'll also have another workshop with Aria Black Book. Very, very important that you guys attend this workshop because you're going to get a lot out of it and it'll help elevate your business. So moving right along, everyone, if you'd like to keep up with our events, please go ahead and text the word BPM REIA, one word, to our event line to keep up with events via text. It is super easy. You can register straight from the text message and register for our events and get reminders and all that good stuff. Alrighty, quick start. We have an upcoming quick start. It is February 4th and 5th. This is a 2 full day virtual Zoom training. The entire training is led by our lead mentor and CEO, Anish Dave. As you can see from the screen, we're getting into a lot of topics here. We're going to be touching wholesaling, flipping, rehabbing, member and non-member pricing. Thank you guys so much for responding to the poll. I have already heard from so many of you. When's the next training? This, that. So here it is, February 4th and 5th. I've linked it in the chat for you guys, or I will in just a moment, so you can see who the guest speakers are, what they do, what we talk about, just some more details on the training. And you guys will all have my contact information by the end of this meeting. So if you have any more questions about the Quick Start training, I will be more than happy to help you with that. But this is a complete money back guaranteed training. Like Anish always says, he is not God. He can't give you your time back, but he will give you your money back if you said that this was a complete waste of your time, which I have not heard of this thus far, but we love for you to try this out, especially if you are thinking about mentoring and coaching, which I'll talk about in just a moment. But we'll keep on moving because memberships, as you all know, get you a ton of benefits when it comes to registering for events at either free or member pricing. Your guests get in for half off for the networking meetings, the entire National RIA benefit package. It's just going to be super useful for you if you're coming to our events and if you simply just shop at Home Depot, because you get a ton of discounts for Home Depot being a member to the association. So thank you guys again for responding to the poll. I know I'm loading you guys up with a ton of information, but I just want you guys to stay in the loop, stay connected, and make sure you have the resources that you need. So thank you guys for responding to the poll. I appreciate that. And as I briefly just mentioned before, we do offer one-on-one coaching and mentoring. This is a strictly one-on-one coaching program. You are matched with your own personal mentor. We do put up 100% of the money for our students' deals and split the profit 50-50. It's a very, very unique program. I invite you to go to the website, book a discovery call. I'll go ahead and throw the link for the website in the chat so you can do that right now. And I'll be more than happy to set up this 1-hour free consultation with you and a mentor. So you can discuss any specific questions on what's included, pricing, all the things that we include in the program. There's a long list of things that we include in the program to make sure our students are successful and have everything they need. So yeah, this is my direct line, and I went through that link in the chat for you guys, as I will be throwing lots of helpful links in the chat for you guys. Thank you for responding to the poll. I appreciate you guys. You guys are awesome and awake, which I love. So just want to take a moment to thank you all. I do realize that the slide that I had for you guys for a special treat from Jason didn't pop up. So let me pop this up right before I go, because this is Jason's just so generous. So this is something that, oh my gosh, guys, sorry about that. This slide was hidden. We do have a raffle today. If you text the word loans to our event line, 954-800-6961, you may be able to win a $100 Amazon gift card. We're gonna have one lucky winner today. I will announce this at the end of the webinar, but of course, I want to take a moment just to thank Jason for that generous offer. Thank you, Anish.
Welcome.
Everyone, for being in this webinar today. We appreciate it. We appreciate your participation. I'm going to hop off of here because I know you guys have so many questions for Jason. I had numerous people tell me like they registered for this webinar like as soon as it came out because of your topic. So
cool.
Jason,
good.
Yeah, our Anish final words, and then we'll hand it to you.
Yeah, absolutely. So like one of the first things is if you win the Amazon gift card, I'm expecting a 50% gift of, and I'll give you my address, and I'm more than happy about that portion too, if you guys feel very generous. No, I'm just messing with you. And I do see a lot of new names on here. I see some people have been with us for a while. So just in case you guys don't know, my name's Anish. I am CEO of BPM RIA. And one of the things that we do is, besides having education and being real estate investors, we're really passionate about teaching and educating people in our market. In case you guys don't know, also, I am a licensed real estate agent since 2002. I've been a licensed mortgage guy since 2001. I worked at banks. I have a degree in finance. And what Jason does is way too hard for me. I think Jason, I did mortgages for a long time when I had hair. I'm not sure. I know, Jason, you've been doing mortgages for a while, so I'm not sure if you had hair first.
Oh gosh, it started going away when the mortgages started coming in. so
the closings on that end of it. And so I've been very fortunate. So as Alexa was talking about was, Jason has been supporting our group for years when we were even called BRIA. And, he's, and I'll let him give his little intro real quick on it too, but with 20 plus years of experience, and on my own personal note was my own financing that I was doing for one of my properties. No one else could do it. And Jason had a program, a bank statement loan that got it done. So I had about, 5 to 7 different lenders saying, hey, it's not possible. It's not possible. It's not possible. I've had other mutual friends that have, referred to Jason, and initially they thought they'd have to put 50% down on that. I was thinking about Alex. And before you know it, he was able to get in, I think, with a 5% loan, and his house is coming amazing, by the way, just on a side note, if
that's good. That's good.
So it's been pretty cool on that. So, Jason, if you want to introduce yourself and some little quick house rules, guys. If you got questions, put them in the Q&A. We'll try to run through them as we're going through the webinar. If you put them in the chat, it just moves too fast for us. If it's super, super specific on a scenario, we may not get to it, but you will have Jason's information. So, you know, if you need to get pre-approved or something that you're working on too. So go ahead, Jason, I'll let you introduce yourself and take it from there.
Well, thank you, Anish and Alexa. I appreciate it being on this Zoom with everybody and all the participants. That's wonderful. My name is Jason Martin Clark. I am a team leader over here with Smart Home Loans, been in the mortgage business for a little over 20 years. And we're located out here in Pembroke Pines. And we kind of have the full gamut of products that people are looking for, anything from your regular conventional to some commercial space and stuff like that. So, you know, I've kind of gone through tons and tons of different scenarios. And yeah, it is tough to make these deals work, you know, and sometimes you'll lose your hair over it, but that's okay, you know, because at the end of the day, I have a nice beard, so I can lean on my beard. But the reality is, you know, today's topic, as far as Airbnb financing is concerned, is something that's very unique. It's a nice niche product. A lot of people are really turned on by the Airbnb prospecting and want to know how they can finance or refinance their Airbnb. And so it's a new product, you know, it's not that new, but it's only been around for a little bit and it's getting tweaked to be a little bit better over and over. So that's today's topic, and I'm looking forward to talking to everybody about it and sharing some of the qualifications that you're going to need for that.
Yeah, and so Jason, like before you we kind of start even talking about, got to put in the chat if you actually have an Airbnb, and if you do, just put how many you got.
That's a good idea.
Just kind of curious as we're going through on that portion, because it gives us a better idea. Think of it this way: this webinar is your webinar on that end of it, so we could change it. We want to show value today. So I'll you know, I see a few of you guys have 1, 3, 7.
Nice.
Okay, got it.
Yeah.
Flex. Okay. Yeah, so some of you guys are actually out there doing it, and hopefully you guys have been doing pretty well on it. So I have a 5-unit building, and I Airbnb 3 of the units here right in Wilton Manor too. So
nice.
I'm on the same boat as some of you other guys out there. So I'm excited too. So do you want to, let's start talking with Airbnb, and then what we'll talk about is some of the other kind of loans out there, just because I know that's the most popular on that. So you want to kind of run down, you know, how that works or what you're
absolutely. Yeah. I mean, it's funny because like with the Airbnb method, you know, I did a loan for a lady probably three years ago, you know, right before the crisis came. And she bought a little place over there in Lake Worth and had a little ADU, like a little, you know, dwelling unit that was attached to it. And she moved out of there and moved to Columbia, and she, you know, let her parents stay in one part of the property, and then she rented the other part out for Airbnb. So when I got to talking to her, I was like, you know, so how are you doing on that? You know, and she's like, I'm doing amazing. You know, like this one little unit that's close to the water, you know, covers my mortgage and then some, you know. And so we ended up doing a cash out refinance on it, and she pulled out what she needed to pull out, and she wanted to get another Airbnb that she wanted to start up, but that was out in Columbia. She was going to buy it cash, you know. So that kind of got me triggered into thinking like, wow, this is a nice, unique little proposition for people, especially when you have an Airbnb and you're not able to tap into the equity of it, you know, and maybe you bought it cash and it's gone up in value a lot. And now that you maybe want to purchase another one, you want to tap into the equity, pull it out, and kind of go from there. So a lot of times, you know, these are not conventional style loans. Okay. It's all debt service ratios. So there's no tax returns to break out, you know, there's no income really to diagnose. It's basically something where the lender, all right, and there's a group of specific lenders that do these types of loans, and some have a little tougher underwriting and some require more documents and things of that nature. But what we've learned through doing these is that, you know, everyone is a little bit different with the way they run their Airbnb business, you know. So certain lenders are going to require a 12-month history. You know, they want to make sure that the average income coming in is, you know, legitimate. And the only way to do that is to, you know, go to Airbnb, you download your Excel spreadsheet, you get the printout for Airbnb, and you kind of match everything together. They look at bank statements for a couple of months to make sure that those deposits are actually going in there that are reflected on the Excel spreadsheet, and they'll finance the deal, right?
So Jason, so before you know, so, you know, some basic terms, because I know someone, you know, You're gonna have to excuse Jason and I. We're
Sorry, I
a
ramble.
bunch of nerdy, finance people. So sometimes if you're new, you want to define what debt service actually means.
Yeah. So the debt service ratio, right? So what they're looking for is the mortgage payment versus how much you're renting it for, right? And so there's a lot of lenders out there that say, hey, listen, we're not interested in short-term rentals. We find that too uncomfortable for our appetite here. But the reality is, like, Airbnbs do probably so much better than long-term rentals, So basically what they're looking for is, and especially with Airbnbs, like if you're netting, I mean, we have a guy right now that's netting like 15,000 a month, right? And that's a short-term rental. A long-term rental, when you look at the comparables for it, like an appraiser will go out there and look at like a year lease, he's only at like $6,800. So the debt service ratio doesn't work for a long-term rental. So we have to shift gears here and get an appraiser to go out there and appraise for Airbnb comparables, which you can find on Airbnb. And so it's a little, pressure point for the appraisers because they don't technically want to do all that kind of work and it's out of their scope. However, if the lender instructs them and says, look, we're the lender, we're loaning you the money, to the borrower, and appraiser, we want you to put these in there for us and, do your job. So the reality is, like you said, debt service ratio is how much it's renting versus the mortgage payment. They want to make sure it covers.
And you said, like, I thought I heard you say no tax returns required.
Right. So,
so put in the chat if that excites you, right? That no tax returns required.
That's awesome. Yeah, that's a good way of putting it. But the reality is, it's a lot of investors, a lot of self-employed, they just have complicated tax returns, and they know they're probably a little smarter than a lot of the general public out there on how to wiggle around the tax rules and so forth. But these types of loans, they don't care about your income. They care about the income of the property. Okay. So if the property income is cash flowing and it makes sense, that's what they want. And as these Airbnbs are becoming more, standard, and you're seeing more and more of them, and it's becoming more mainstream, the lenders are saying, wait a second, this is a good product for us to service, because I mean, at the end of the day, like, it's already built into the fabric of the Airbnb short-term rental VRBO type of system, and they know that their asset is protected,
Yeah.
So
can I just, on that second part of that question, and on the no tax returns,
right.
Do they still need to provide, and this is what I mean, provide tax returns, meaning that they filed them, right? Like, hey,
Right.
because there's some hard money lenders out there. They're not really looking at your tax returns for coverage
Right.
or what you really made. They just want to make sure you filed them. Are these lenders at least requiring, again, they're not going to use the income, that you at least
Right.
file tax returns, or they don't?
No, what they want to see is, I mean, basically they just want to see what type of, job you're in, so forth. But they're not looking for income from you as far as tax returns. So you don't need to break out, tax returns and show a payment history or how much you owed or how much you paid. Like, that's completely off the rails for them, So that's where we come in to kind of facilitate that and help the borrower get the right documentation to kind of custom fit that particular loan, and some of these lenders, they'll go down to a 625 credit score for Airbnb, like, it's not where you need a 700 plus or 725, like, they'll go down as low as a 625. A lot of them will finance 75% loan to value of these Airbnbs, especially on purchases. When you're doing a cash out refi, that might cap out like at 65%. But they're getting more exotic on those types of products, and that's something that I wanted to share with your group.
Yeah. So what Jason's saying on the acquisition, right? If you're buying something, like, the bank will lend you 75%. So for using $100,000, the bank will give you $75,000. You got to come up with 25% down plus closing costs.
Correct. Yeah.
On that same scenario, do they need, I know you're going to get to all this stuff, but I'm just bombarding you at the same time with questions. Will they need reserves on something like that?
Yeah, they're going to want to see reserves, in some cases, depending on the debt service ratio, like if it's cash flowing really well, they might ask for 6 months reserves. If it's not, they're going to want to see that you can cover the excess that maybe you're short on if it's not cash flowing. But most of these Airbnb units all cash flow. It's only the long-term rentals that have issues with cash flow. And so then they might ask for 12 months reserves. But from what we're seeing, like these Airbnbs are outperforming like long-term rentals. Like it's almost incredible how well they're doing,
Absolutely.
Especially on the gross.
So what we're saying when we talk about reserves, guys, I know some of you guys are experienced, some of you guys are not. So kind of bear with us. So if your payment is $2,000 a month, your new payment on the loan,
correct.
And Jason's saying 6 months, you need to have $12,000
in a bank account somewhere.
Account somewhere. It doesn't have to be with that bank also. I want to make sure that you
it could be retirement, it could be annuities. It just has to show that you have some, liquid assets that you can tap into. Maybe not a Roth IRA or something like that, but some other type of stocks and so forth.
Okay.
Probably not Bitcoin, but something that they can see and feel. But that's definitely what they're looking for in reserves.
Got it. And so like if I was buying something, right, and it's not let's talk about two scenarios.
Right.
I'm buying a rental, right? I'm looking for a property, and it is already an Airbnb from the seller.
Right. Okay.
Right. And you're talking about the acquisition on that portion. Will they use the seller's information for the 12 months as Airbnb numbers, or is it the appraiser does it himself, or how does that kind of?
That's a good question. So they like to look at all information, right? So like this is not like just your typical underwriter, okay, that's going to sit there and look at this and say, all right, well, it doesn't fit this box. They want to look at all information. So if we need seller information on the performance of the Airbnb, we'll get it. We'll request it, especially if that's what they're trying to sell. They would have that readily available, just like anyone else selling a commercial property or 5-unit would have their rent rolls ready, right? But more importantly is there's a handful of lenders, and one in particular that will allow us to choose an appraiser to go out there, all right, and appraise the property according to Airbnb comparables, and so there is these specialty appraisers that are starting to get into that niche. And one of our lenders in particular said, hey, look, you know what? We have a team down there that has access to Airbnb. They're really good at doing it. And we send an appraiser out there. And so what they'll do is look at that rent schedule on an Airbnb short-term rental performance as opposed to long-term, so either more, standardized appraisers might go out there and say, hey, look, I can't do this deal because the rents are, $5,000 versus what you could see on Airbnb at 15. So you kind of need a specialty type of appraiser to handle that. And that's how that would work. But yeah, more information is always going to be better in the equation when you're trying to approve a borrower.
Yeah, absolutely. And so let's see, I find something like, are you seeing, what's your turnaround time on getting an approval or underwriting, or like?
They're pretty quick. I mean, it's a little process putting the package together, a little bit more, information when it's coming to, if you have an LLC versus an S Corp, we might need an operating agreement, and some people might not have that. So we kind of just pull it all together. And once we get it into underwriting, I would say it's anywhere from, 48 hours to 72 hours. Okay. As far as an approval is concerned. But the main, meats and potatoes of this is when they actually get the appraisal in, because then that changes everything, as far as like documentation from the borrower, like I said, rent rolls, Airbnb breakdowns, the LLC operating agreements, some other generic information they'll need. But once the appraisal comes in and says, all right, look, you know what, we missed our target, we overestimated, then we have to rearrange a few things. But most of the time it's coming in on target, like it's pretty easy for us to go into Airbnb or have a client go into Airbnb and say, all right, look, this is what we're renting at. And you know what, the appraiser should be able to find those actual comparables as well. So we work with the appraiser on that.
Yeah, and I just also want to clarify, when we're saying Airbnb, it's any short-term rental,
short-term rental,
like
yeah.
Obviously, so I know some of you guys are using Booking, some of you guys are using VRBO, depending on what kind of houses. So every time we say Airbnb, or if you hear us say STR, short-term rentals.
Yeah, that's right, STR, sorry.
Yeah, no, it's okay, because I always have people ask me like, well, what do you mean it's only Airbnb? So I know sometimes we get kind of caught up. We're just using terminology that everyone's familiar with. But if you hear, Jason or myself say Airbnb or STR, short-term rentals too. So
Yeah, that's what it is. Yeah, exactly. So yeah, I mean, that's it in kind of a nutshell as far as the financing goes for that. And
what about minimum loan amounts? I'm gonna grill you, like I'm gonna rapid fire you on some
you
questions.
know what, minimum loan amounts, I would have to get back to you on that, because honestly, like all the loan amounts that we've seen are pretty big, you know, and I would have to actually find out what a minimum loan amount is that we can qualify. But it'd probably at least be $100,000 with some of these institutions. They're not, you know, they're bigger institutions, hedge funds, they're ran a little bit differently. And so they have an appetite for, you know, bigger loan amounts versus the smaller ones, because there's so much work that goes involved into it. Like they just want to be able to, you know, get the bigger deals, so to speak. But I haven't had smaller loan amounts on the Airbnbs, but I will find out for you.
Yeah, and I agree with you. I'd be surprised if it's. I doubt it's less than 100. It might be even less than
Right.
It might be even 150 as a minimum. Just because you got to remember on the lender side, it's a lot of work, and for them it doesn't make any sense on the smaller loan amounts.
Yeah, not only that, you know, there's points involved that you got to pay in closing costs and stuff like that. So all of a sudden, if you have a 100K loan amount, like it might not make sense for that particular, you know, Airbnb investor to pull the trigger on something like this, you know, especially
what kind of rates are you? Let's talk about, are they fixed rates, ARMs, or you could do either? What are these?
Yeah, they have prepayment penalties. All right. You know, so you have like a 2-year prepay, 3-year prepay, 4-year prepay. The more prepayment penalty that you get, because it is an investment loan, the lower the rate gets. But we're seeing rates anywhere from 8.875 on a cash out refi, you know, down to, you know, 8.5% if you're coming in there with a little bit higher of a prepay. I know some people look at prepays as a, you know, like an awful thing, because it kind of ties you to the property. But the reality is it's not, you know, in most cases, like if you have an Airbnb and you're cash flowing and you're pulling out cash or purchasing it, you know, the lender's got to be protected at some point, you know, because they're the one facilitating it and they want to be able to obviously make money off the interest that they're loaning. So they're not bad rates, you know, honestly. Like I thought they would be a little bit worse, but they're in a different sector of business where it's not technically affected by the Fed, you know, rates getting jacked up and stuff like that. I mean, it will eventually, but they're not awful rates when it comes to those types of loans. You know, 30-year fixed is an amortization that you're looking at with a prepayment penalty and so forth.
Got it. Hey, Jason, I'm going to let you kind of chat for a little bit. You're going to laugh. I'm actually, my contractor is at Home Depot. I got to pay something real quick. And
sure.
I'll let you kind of take it. I'll hop right back on.
Okay, no problem. Let's go here. All right. So I have Ben. Ooh, let's see here. Okay, I live in a duplex and one side Airbnb out the second half. What type of loan does that call for? A down payment required. Okay, so Ben has a good question, right? So he lives in one duplex, right? He has a duplex, lives on one side, and the Airbnb's out the second half. That might not necessarily work for you, okay, because you're living there, I would assume, as your primary, okay? But I can double check with my lenders on how to treat something like that, because obviously it's going to be based off of the cash flow that you're making on that one unit on the other side. So if that other side is cash flowing enough for it to make sense and you wanted to purchase another property, then yeah, we'd have to take a look at something like that. But if you're going to live in it, then it's a primary occupancy. And technically Airbnbs are only set aside for investors. You know, that's why they put a prepayment penalty on there. They won't do it as a primary. So that might disqualify you if you're, you know, if you're living in one of the units. So you'd probably want to be living somewhere else and renting both units out and looking at the cash flow of both units in order to purchase something like that. All right. Any more questions here, Ben? All right. Let's see here. Hey, Alexa, how's it going?
I'm right here. Hi. We do have a ton of questions in the Q&A, and everyone, if you put your question in the chat box, please be sure to go ahead and enter that in the Q&A so we can run through all the questions, and we don't want to miss your questions. So I'm going to pop in the Q&A and see. Wow, lots of questions here.
Yeah, I got a good one here that I see from, I think Alejandro. Let me see who it is. Alejandro. Yeah, Alejandro's asking, all right, does a new LLC with foreign national owners apply to this kind of loan? And oddly enough, yes, it does. And I have an actual foreign national, they're Canadian, and they live elsewhere, so the way the foreign national Airbnbs work is the same kind of a deal. The thing is, with the application portion of it, we have to be very, sensitive to that, because we want to make sure that we have an address of that foreign national that's living somewhere else. It has to be in Canada. They're going to verify the address up there. Secondly, the rates are not like, the rates are actually, those are the rates I was quoting right now on my foreign national deal with one of my lenders on a cash out refinance at 65% loan to value. And they're looking to pull out, it's a big loan. They're looking to pull out a lot of money down in Miami. But yes, to answer your question, we do foreign national loans. And there's a certain documentation list that we got to put together for them. Actually, I have it right here. Passport to qualify, 2 months recent foreign bank statements. You got to wire the funds directly to the title company, letter of good standing from your bank or origin, or 2 months bank statements in good standing. And then they'll use a Google Translate as an actual translation if we had to go ahead and translate your bank statements from, let's say, Desjardins Bank or something like that, that is maybe in French or something like that. So yes, we do have those types of loans for foreign nationals. So I hope I answered your question there, Alejandro. And you see any more in there, Alexa? Let's see.
Nice. So in the Q&A box, if you hover at the bottom of your menu, just for everyone, because I have some new Zoomers in here.
Okay.
So Anish, we have a ton in the Q&A box.
Got it. Okay. So, hey, sorry guys. When you're rehabbing a house and your contractor calls and you need to get paid, we got to make sure. So, and of all things, at Home Depot.
Yeah, exactly. Home Depot. That's your home after you buy a house. Actually, that's your second home.
So I apologize on that. I know you're kind of going through the questions a little bit. On that end of it, and I know we were talking about our last conversation a little bit about loan amounts was one as a minimum. Prepayment penalties. I just want to touch on the prepayment penalties. It shouldn't be a big deal, meaning people get upset about them. My point is, I didn't mind paying a prepayment penalty if I made a ton of money on the other side.
Correct.
The other end of it is, if you've been watching our webinars with Jose Ramirez, Advanced Tax Advisors, you should be keeping these properties for cost segregation.
Nice.
So, I just think don't get caught up on that issue. Don't get caught up on the rate, right? Oh my God, it's 8.5, 9. Look at how much money you're making and to be able to access that end of it too. So I'm sorry about that. You might have touched on that.
That's a great point. A lot of people zero in on rate, and it's really payment, and so if the payment makes sense and you're cash flowing, that's perfect. If you have a prepayment penalty, it's not the end of the world. It could be a 2-year or 3-year. And oddly enough, these years go by very quickly. We just had 2020, the COVID pandemic a couple of years ago, and now all of a sudden we're sitting here and we're hanging in there, but, it just helps with getting a little bit better rate. And it also protects the lender, trust me, these lenders would love to give their money away for free, but they're not going to. They want to safeguard it, and they have to stay in business and pay their employees and overhead and things of that nature. So if it's a win-win situation and they can get you a loan on something that is very unique, like an Airbnb property or a cash out refi on a property, so you can go reinvest that money somewhere else into another Airbnb, then yeah, absolutely. Pull the trigger, do it, and go get yourself another Airbnb or short-term rental.
I know you were talking about the refinance, the cash out refinance, and you said 65% loan to value. Same thing, are they using 12 months?
That's mostly where we're at on those. They're a little more conservative when it comes to cash out refinance. If you got a hard money loan or something like that and you got to pay that out, obviously, you could pull some money off of the table, take some gains out of it. As long as it's making sense and still cash flowing, then that's just the way it goes. It's
and that's using a bunch of different strategies at once, right? Like maybe the house is in bad condition, it's got no money coming in, you get a hard money loan or a private loan. You could refinance that out into maybe a regular loan, get it stable. Maybe you fix it up 3 or 4 months. And it's a year now of you putting Airbnb numbers, and now you could pay off that loan and into this Airbnb and take out some money. So hopefully, it's like a path, right? And that's what real investors that are in this space are doing. So I think it's always important to actually have that, plan on that portion too. So
yeah, I think so. I mean, like you just said, if you can access the cash in your Airbnb, and over the last 3 or 4 years, they've gone up in a lot in value, especially with the way the market is now, I think, I mean, the market's starting to stabilize a bit or come down in certain areas, and so the appraised values are starting to, be up there, but, the sales prices are coming down. And so that's going to just gyrate towards a little bit lower of equity. So the time would be now, to strike because, or even, earlier in the year, to go ahead and get, as much value out of some of these Airbnbs on cash out refinances as you can,
Absolutely. And did we talk about property types? Are we?
No, we didn't, but
So,
yeah, I mean, as far as property types, they would consider all types, these lenders are not, just, relegated to single family homes or just want condos. They're more interested in, like, are you cash flowing? If it's a fiveplex or a duplex, triplex, single family home on the water, is it cash flowing? Where is it at? What kind of property is it? Like, they're not necessarily too concerned with it because it's their own money they're lending, even if it's a commercial space or something like that you're Airbnb and you broke it up into certain, rooms and areas or something like that. So they're not too, focused on like, oh gosh, we only want single family homes,
Okay. And that because that's important. What about on whether it's a 5-unit, 8-unit?
They love it. Yeah, that's better for them. I mean, at the end of the day, it's a great asset. They're not making too many 5 units anymore or 8plexes or quadplexes. You don't just see those popping up all over the place. Everything is single family homes, condos, townhouses. So when you get your hands on a niche product like that they're not making anymore, like it's almost like striking gold, and they prefer those, because there's more doors to rent versus just one house, and in case something happens,
Yeah. And I mean, it sounds like, obviously you're saying some of these lenders are like hedge funds and those kind of things. So I always kind of joke about it. They're usually smarter people than the bankers.
Well, you know what? They got their own money and they kind of write their own rules, It's at the end of the day, like if they're writing their own rules and they could take that, it makes sense, hey, look, let's take a look at this guy. He's decent. He's got the assets, but, we're going to bring it over to our underwriter, and the underwriter would take a good look at it, but they don't have all the hoops that you got to jump through for conventional financing. For conventional financing, you can't even use short-term rentals. I tried doing it once and they're like, nope, that's not happening. We have to get a regular rent roll for it, or a 1007, which is like an attachment to the appraisal to see what that's.
And that's the point of it, right? Like you got to actually use it's outside the box, and because it's outside the box, right, that's why you're paying a little bit more on interest rate too. Like
I mean, look, that's at the end of the day, that's what it is. I mean, these banks got to make money too, and they have to hedge against inflation, and they have to hedge against things, and so they're going to offer a little higher rate. But I mean, if it's cash flowing and it's making sense, and you can purchase another one and another one, that's kind of the idea there, is especially if you're becoming an Airbnb, building an Airbnb empire, like how do you access more funds to continue buying more Airbnb, because they're expensive. You got to set them up, you got to close, you got closing costs, you got furniture, paint, you got to make it look sharp. I know there's certain standards that Airbnb and VRBO want. They're not just going to have a house on there that's in rough shape. That's not what they're marketing. They want to market a nice, pretty property, and it takes money to do that kind of stuff.
Absolutely. And I'm going to kind of fire through because there's so many questions. So I'm going to
fire away.
So Latanya is asking, is there a cap on what the value of the property needs to be? So
not necessarily. No, there's not really a cap, on what the property needs to be. So
Latanya, that $20 million house you're going to buy,
go for it all day. Get it under contract.
Absolutely. And Justin's asking, how many loans may you have with the same lender?
You can have as many as you'd like. The same lender would prefer that. It's not like your conventional rule where it says, okay, only 10 rental units, that's it. After that, like we're not loaning you any more properties. With Airbnb, you can have as many as you like with the same particular lender. Once you build that relationship up with that lender, it's much easier to kind of go through the whole process because you already know what documents they need. Just got to update things and get an appraisal. So yeah, I would prefer to stay with one lender, and if you can build up your portfolio with them. I mean, maybe at a certain point, if you got 100 of them, they're like, hey, wait a second here. We don't, like if you default, we're in trouble here. But that's something I haven't experienced yet.
And what about the title of property if it's inside a trust or LLC? Not an issue.
Yeah, they're going to want to see the trust. They're going to want to see the trust agreement. They're going to want you to break out that documentation and kind of pierce that veil just to make sure, it is what it is. But that's kind of typical, even in conventional type of loans. You're going to have to open up that trust a bit and show us what's in there. LLCs, it's going to need an operating agreement. If it's in a corporation, I believe it's called a, gosh, I forgot the name of it, but there's something for a corporation that they would need as well. And so a lot of people don't have those readily available. If they're well versed and been in this business a while and working with good accountants and so forth, they would have it. Yeah. And sometimes they don't, and so we kind of help them out and kind of put it together and help them kind of just, work through that process of getting the one that the bank's going to want to see.
Yeah, absolutely. And so Mariana is asking, what happens if the short-term regulations change? I mean, I would just say that if you already have your loan, they're not going to call your loan if you're making payments.
Yeah, look, that's more of like a municipality kind of thing. Like if you're going into a city and, and they say all of a sudden say, hey, listen, we're scrapping, short-term rentals. It's not what we want to have over here. Maybe like some of these more affluent cities and stuff like that. Then that's something that the lender would have to, honestly, like that's something that the borrower would have an issue with, because then you're at a point where if you can't rent your Airbnb and you're not cash flowing because the city or the municipality is saying, look, you know what, we're doing away with this, then yeah, you're going to have to make a decision either to get into a regular conventional loan, sell the property and kind of make a move, but that's real estate 101. You have to make a move in order to make an adjustment.
Yeah, you got to have multiple exit strategies, and that's why you always need reserves too. So Shannon's asking, how does a prepayment penalty work if you sell the property before the loan ends? Is there just a fee on top of the payoff? Yeah,
typically the way they work is it's 6 months interest that the lender wants to collect. Okay, so we figure out your interest, and if you have a payoff, all right, the payoff's 100 grand, just tack on another, let's say it's $1,000, right, of interest. So tack on another $6,000. So that's how that works. It's usually 6 months interest. There is certain prepayment penalties that kind of work in a tiered avenue where it's like, all right, look, if you have a 5-year prepay, the first year you're going to get hit 5% interest. The second year, 4%, and so forth until it gets to 1. So that's a little more attractive because it kind of entices the borrower to say, all right, well, it looks like the lender's working with me, I'll work with you, so that helps out as well.
And I'm going to also clarify, because we always think of prepayment when we sell it. It's usually 20%. Am I right? Still, is it 20% of the loan paid off or more? Like, meaning like you might refinance it, right? You're still going to get hit with a prepayment penalty.
Correct. Yeah. If you refi or sell, it's the same rule.
Or you pay it off.
Right. Look, they will allow you to pay a certain amount per year. They don't want you to pay it down so quickly, but they will allow you to pay down a certain amount per year. And that just goes on a case-by-case basis, depending on the borrower and the program we're selecting. So it's not out of the realm to pay the property off, but if you want to save the money and not get hit with a prepay, maybe you just pay a portion off, another portion, and kind of get to the point where all of a sudden it's owned outright.
Yeah. And the point of that is, like, you might get chunks of money. You say, hey, I don't want to pay this off. I need to park my money on that. And so make sure before if you do any of these kind of loans in general, prepayment loans, talk to your lender first. It's worth the phone call and find out, if you're going to get hit with that, because I've seen that too many times, because we just always assume that it's only when you sell it. So
it's refinance, rate and term refinance, whatever you do with the property that's going to change ownership of it, like that's where the prepay comes in. But I always try to reiterate to the borrower, like, look, this is not news to me, not news to you. You are getting a prepayment penalty because this is how these deals work. And so most people will know that going into their loan, so that this way they can set up for that in the future.
Denise is asking, do you have investor loans that will cover the initial purchase of the property? If so, what type and what are the requirements. So I'm assuming
Okay.
that's just in general as an investor loan.
Yeah, I mean, we have a bunch of different type of loans, a bunch of, different type of niche products, you have the DSCR loans, the debt coverage service ratio loans, where we don't put, income on there. We're really just looking at it. And if it's long-term, that's fine. We have those types of loans that can go up to 80% on cash out, or 85% on a purchase. In some cases, like, lenders are starting to pull back a bit on their LTVs. So it's kind of like a given, touch and go situation there. But we do have those types of loans, bank statement loans, if you want to qualify for a little bit better rate. But honestly, like, those DSCR loans are really competitive with rate, and they prefer those over bank statement loans, because bank statements just reveal so much. If you're buying a primary, yes, you could do a bank statement loan as a primary, 10% down. Rates are, a little up there, I would say probably 9.99 or somewhere right around there. But they do have those investor loans that we can get for all types of people, and different types of properties too, multifamily, commercial, warehouses, things of that nature that, people might be sitting on and want to cash out, refinance, or purchase,
Yep, absolutely. And so, do they also offer on the Airbnb interest only loans? And what's the typical, like, when we're talking about points,
right?
Like, how much, what are you, like, is it 2 to 3?
So they have, like, there's a couple scenarios where you can, you're probably looking anywhere from 2 to 3 points on the upfront, and you have your, your processing fees and your lender's fees and so forth. Then there's a way where they can add the points, with certain lenders, where they can actually add the points into the loan. All right. And then the loan will be a little bit higher, but your points are kind of buried in there. So you're looking anywhere from 2 to 3 points on certain loans, depending on the borrower and the situation. And points are technically, always negotiable, as far as being competitive, so it's just a matter of, looking at that particular situation and saying, all right, well, this is what we have to work with here. Like, we need to be here in order to facilitate the transaction and make it work for cash to close or cash out refinance or something like that. Interest only loans are available. Okay. But they price out a little bit higher,
Sure.
So they like the principal and interest type of loan. It's a little bit more, you're paying interest and principal down. So it just depends on the borrower, but those different scenarios are out there, and we can figure that out for you.
Absolutely. And do you need multiple LLCs to have multiple loans, or can you put it in, like, does that matter to the lender per se?
Well,
like, we're not talking about asset protection, Kenton. So
right.
Different things, where this is all on the lending side.
Yeah. So what you're saying is that we want to have it in an LLC. They're going to want to see a corporation. You know what I mean? They're going to want to see some type of corporation that owns the property. They're not going to want to see multiple LLCs. They're also not going to want to see multiple people on the LLC. So we have to clean that up a bit in order to make sense of it. Because what they're looking at is, like, if you have multiple people on an LLC, and then all of a sudden the operating agreement reflects the same, like you got a 50-50 partner or something like that, they're going to want to put that person onto the loan. All right. So that 50-50 partner on the operating agreement might have to be only a 10% partner. Okay. So this way you have, the bulk of the ownership. And by virtue of that LLC, that operating agreement, the underwriter can say, all right, well, look, I see on Sunbiz or something like that, that there's, some partners on there. Let's take a look at how the partnership's drawn up. And then we're concerned with the borrower. All right. So as long as the borrower has the majority stake here, then we'll use the borrower's information. But, that's a case-by-case basis when we're looking at that.
Yeah, that's a good question, because I know some of the guys that I know, hey, Jason owns the property. We're having our LLC in the operating agreement. I'm going to handle all the Airbnb stuff. And, maybe the ownership's not tied directly. So it's truly a case-by-case situation on that portion. Can they do these Airbnb loans in a personal name, or does it have to be in a corporation?
No, they want it in a corporation name. They want it in a corporation name for the mere fact that it's an investor loan. It's clearly an investor loan, and so if it's in someone's name and they just want to hedge against people trying to occupy it as a primary, like that could happen. So to make it very clear that it's an investor loan in case they ever have to foreclose or something like that, they're going to want to see it in a corporation name.
So like, if I owned a fourplex and I was house hacking, right? I was living in one, and the other 3 units, and now I Airbnb the more short-term STR. Now that would be an issue because I'm living in one. So it has to be
Well,
truly, or
yeah, I mean, it'd be an issue if you're living in one, but if you're technically not going to live there and you're going to rent it out, like there's a lot of people that have that. They started off with a quadplex. They bought, 8 years ago. It's FHA, and then all of a sudden they turned it into an Airbnb. They've been renting it out for like that for 3 years, living in the unit. So you have to make an exit strategy on vacating the property. Like you would have to show proof, like, hey, look, I'm leaving this property. I'm going to sell or really refinance it, and then I'm going to get an Airbnb loan on it. So you'd want to show that you're not living there, and by virtue of not living there, you're going to have to open up a business. And we can help you open those businesses up so that this way you get all your ducks in a row, so that it looks like a legitimate, an investor type of purchase or refinance.
Absolutely. And Dolly's asking, will the banks fund loans on international property? It's just you're dealing.
That's I'm not the international lender. I wish I was, but I would have to find out about that. I mean, look, the reality is, like, they have their own money, they have their own rules. And if it makes sense, if it's in Canada, Puerto Rico, or the Dominican Republic, something like that, I would have to find out, because I've had that question asked to me a few times. And all my avenues are kind of like saying no, like we won't.
I don't personally, I don't know anyone that would. It's just because they're worried about in a foreclosure. Like, you talk about states being one way, countries is a whole different aspect of it.
Yeah, it's a big risk, like, it's a big risk for somebody, to finance a property in Dominican Republic or something like that. And
I would say no for now, Dolly. How about that?
Yeah.
I'm not gonna say a definite no, not probable.
Yeah.
How about that?
Yeah. I mean, I know they're out there, it's just, you got to look at those countries and those banks out there that will facilitate those transactions. But, as far as like the States, no.
Yep. Venus asking, where do I find these appraisals for Airbnb? You actually, if you do the loan with Jason, the lender will take care of that for you.
They have a panel, like they have a specialty panel that they've been using, and it's much easier for that panel of appraisers to work with that one specific lender, or a few of those types of lenders, because I couldn't tell you where I could find an Airbnb specialty appraiser, right? I mean, I can't just look in the phone book, or, not the phone book, Google it or something like that. You have to ask around. So I lean on the lender's expertise for something like that. That's kind of their niche. They've carved it out. And that's where I would say, hey, look, you know what? Here we go. They're going to get me the appraiser's information, and then we can kind of go from there and order the appraisal.
Absolutely. And so someone's asking, does a higher credit score qualify the borrower for a lower rate, or is it solely based on the risk type of a loan?
Yeah, it does. The credit scores always come into play for, U.S. citizens. Obviously, the better the credit, the better the rate. That's definitely something that's going to be an advantage, but it's also to just let you know that people that have great credit can get it, and people that don't have great credit, we can go down to a 625, as long as it's making sense for them on the debt service ratio, then that's what they're looking for. But yes, credit does play a major part in getting a better rate across the board everywhere.
And I know you touched on it, that the loan has to be in a corporation name. Is it personally guaranteed?
Yeah, all these loans are personally guaranteed. It's really like hard to find any kind of lending institution that's not going to want a personal guarantee a loan. I mean, maybe business lines of credit or something like that might not have that, but for sure, without a doubt, they're going to want to personally guarantee the loan. It will come up on your credit report in most cases, and that's just it's just the way it is.
Yep. Jim's asking, can you get loans based on long-term commercial rental income to corporations? So I'm going to say that's not an Airbnb, just in general.
That's a good question. So it's say that one more time, Anish.
Yeah. Can you get loans based on long-term commercial rental income to corporations?
Yeah, I mean, that sounds like maybe a cross collateralization. If you're looking at long-term commercial rentals, and you want to be able to use that to qualify for another loan, that is definitely something we can probably figure out for you. And it seems like it's maybe, I wouldn't call it a bridge loan, but it's like a cross collateralization type of loan. Like you're basically borrowing money, based off of the rent rolls that you have on some commercial property. So yes, we can do something like that. There is avenues for it.
Got it. So Elizabeth's asking, so she just finished a rehab on one of her properties. She has a hard money loan right now, and she's looking to cash out refi. They want to do an Airbnb on the main house and garage, which is converted. Do we need to first rent it out as an Airbnb before you could cash out refi?
That's a good question.
Super specific.
Yeah, that's a good one. Who's that, Elizabeth? All right, that's
Yeah.
a good one. All right, so what I would say to that is, before you Airbnb it, right, and rent it out, I would say it's just to get a regular cash out refinance done first, and as an investor, you're probably going to have some better terms in that case. But I would definitely look at both avenues for you, because oddly enough, when I'm pricing out regular investor loans versus Airbnb cash outs, like I was surprised at the rate that these companies were given, and they were very aggressive in that aspect. The loan to value might be lower on an Airbnb versus, a straight investor cash out. So that might be something that you might want to, figure out, because if you're looking to pull the most out, then maybe we go straight investor loan, get it done, nice, decent rate, versus the Airbnb where you can't get as much cash out that you're looking for. So I would probably go straight investor, cash out refi, then put it on your, on Airbnb and rent it out just like that, and you're set.
Yeah, that's what
on the initial, question that I'm looking at here, but maybe things change when we have a conversation.
Yeah, that's what I was going to say. The best, I know
Yeah.
that's super specific. So I know some of your guys' questions are super specific.
Yeah.
Point of Jason, right? So he works for you. So I always kind of laugh at it. It's not like really going to a banker, because I've worked at banks. Tell them the whole story, please. Like what you're really looking to do, what you're doing it.
Yeah.
His job is to place it and put it together if it makes sense. Right. Like, I mean, that's what he is like, like, oh, I don't want to tell Jason this. And then you go through the underwriting process or do all stuff and then it shows up, right? Like, you're like, I didn't know that was important. They're going to find out. So just like to make his life easier, which will make your life easier to get it done, is that, tell him the story, right? Like if you're like, and I appreciate Elizabeth saying, hey, this is what we're doing and this is where it's at now.
Yeah.
Right?
Just,
because he's got a story.
And if not, I kind of pull it out of people because I ask the questions that I need to know, because I'm thinking like an underwriter and I'm wondering, okay, well, how do we work around that? And I just want to be straightforward. I don't want to, waste your time or something like that, or give you something that might not work out. And sometimes they don't work out. It's just, hey, listen, it just didn't make sense. And we got into the file and the underwriter doesn't like it. But yeah, the more we can converse and figure things out and kind of put a plan together, the better off we are. And, I'm on your side, I'm going to fight until we get this deal done. I'll find a different lender or, multiple different lenders that'll take it. And sometimes you have to just kind of like restructure and repackage it and send it off to a new lender to make it work. But that's what we do, like we try to help you guys out as much as possible. And then this way, make the process as smooth as possible, because it isn't an easy process for anybody. I mean, sometimes there are a lot of bumps in the road, and a lot of it might have to do with the appraisal, or the condition of the home, and not necessarily the borrower. I mean, if you're not putting down any income and we're just using your credit score, like there's not much we need from you, other than some business and bank statements and so forth. But it's the questions, like, hey, what's that large deposit? Or, you know what I mean? Or, hey, why does this appraisal have, boarded up window, and then we got to figure something out from there. And
I'm gonna let you guys know something. So Jason only makes money if the deal closes.
True.
So he's got a vested interest. Let's not like beat around the bush.
Yeah. We work for free until it closes, and that's how we kind of operate.
So that's why I tell people, like, look, you want to make sure and you want to make it easy. And on a second end of it is, if you are, and I know some of you guys have loans and process with them, if Jason asks for certain documentation, it's not because he wants it, it's the lender, right? And so when you're like, why does Jason need this? Well, Jason really doesn't need it. Your lender that's going to lend the money. I know it sounds very basic, but when I was doing financing, that used to drive me nuts. I'm like, look, why didn't you tell me in the beginning? I'm like, no, they looked through some stuff. They need some clarification.
Yeah, no, listen, and there's going to be, there's going to be certain borrowers out there, that it's paper intensive, you know what I mean? And I hate to call you up and say, I need another one. And it's like, I just sent that over. I need another one for this. it's just paper intensive, and that's just how the business is. And for us, we are very organized on the back end. We put all the papers together, we label it and relabel it and make sure it's crystal clear. We review it, and then we submit it to underwriting, and then underwriting might catch something that we didn't catch, and then we have to work around it, letter of explanation or something like that. So, don't feel bad that I'm asking you about a lot of, don't get frustrated, don't get mad. I'm just trying to facilitate it. And if it was easy peasy, then everybody be doing it, but it's not, but documents are
we want to
important.
set those expectations up front, right? And
Yeah.
and the thing is, like, I always kind of joke that when I used to do loans, like Jason's a much nicer guy than I am, but I used to be like, hey, think of us like we're going to be dating. So you better, when I email you, like, we're going to be talking a lot, right? So
Yeah.
don't be ghosting me. Don't be like, I'm too busy, right? Because this was what used to drive me nuts, right? They're too busy to get you the information that you need, right? And then all of a sudden the date, like, hey, why is it taking so long?
Right. Yeah. Sometimes that's just common with a lot of investors and stuff like that. They got a lot of things going on, a lot of projects, and they'll slow roll on some paperwork, and we're kind of pressing them. And it's just you work with me and I'll work with you, and I'm your guide, and I will follow up, and I will ask, and I'll text you at 6:30 in the morning or whatever the case is, because I'm up at 5.
And he does text in the morning. I'm a morning.
And I have to start early, because the only way to get your day set up early is to kind of, start off that way, but the reality is, like, we're in it to win it with you guys, and we want to be able to help, and we want to be able to help all the members and stuff like that, obviously grow their real estate portfolio, that real estate empire. And I know Anish and his team is awesome at definitely helping everybody out. And I just want to be able to be part of it and lead you in the right direction. And sometimes it doesn't go as planned and it's not as perfect, but the reality is, like, that's life, there's going to be little bumps and bruises along the way. And I might not be the perfect lender for certain people, but for the most part I am, and I've done pretty well with it. And I try to get a 5-star Google review out of it, just to make sure that people are happy and committed. But like Anish said, yes, I'm not a paper hawk, but I have to be, that's just my nature of the business.
You'll laugh, because I'm going to ask you this, because the loan Jason did for me, that was about 2 years ago, actually. Like, that was July, actually. A little over 2 years ago.
That was a good loan.
That conditional approval, and maybe I'm wrong on this, at that time, remember, I don't know how many loans you've done in your career. He said that was the longest approval list of things that he needed.
Oh my God.
And I mean, when I used to do loans, I was like, oh my, wow. But luckily I'm like beyond organized.
Like, you were amazingly organized. Like, everything we needed was like bang, bang, bang. And it was, I mean, honestly, when I look at my files and I'm like, holy crap, I had all of these documents, because it was COVID, and it's just a really odd time to get a loan, what we did there, investor cash out and all that kind of stuff. And, but in the end, it took a while, but we were successful. And I think that was a great deal, because you got an ultra low rate.
3.75
compared to what they're out right now. Yeah, exactly. So it's like, you just got to gear up to different market, different rates, different conversations, and I'm trying to just explain to people, like, look, if the payment makes sense, and you're not paying rent and you own the place, then, don't look at the rate so hard. Maybe there's an opportunity down the road to refinance. But for investors, for the most part, like, I feel like if you can always raise rent, and I think that's been happening a lot.
And you should be, like, first of all, like, if you're a landlord, and I'm just going to say a typical, rental, and let's not talk about short-term rentals, you should be raising rent every year. Like, I don't care if it's $50. You have an $800 unit, that you're renting, get it to $825, $850. Get your tenants used to, raising rent. The big I word that everyone's talking about, right? Inflation, right? So if you don't raise rent, guess what? The money you're making now is less. It's worth less, right? Or purchasing power than in the future. Right. So you want to make sure you're doing that. And then on the other end, if you have multi-units like I do, it actually increases the value of the property when lenders look at it, because they're looking at cash flow. Same thing with the Airbnb. That's universal all the way through. I know it's so crazy. Like, I know we've been focused on Airbnb, and I feel like we've crushed a lot of it. I just want to talk about, like, some of the other loans that you do. You talked about, debt
Yeah.
service, statement, bank statement loans.
Yeah, I mean, we have a whole gamut of different type of products, especially for the self-employed borrower, and that's kind of like my niche, is to help out the self-employed borrower. The W-2 pay stub, we'll take that all day long. It's your regular conventional FHA type of financing. But
and by the way, Jason loves the FHA conventional. He doesn't he just doesn't like hard loans. So
yeah. I mean, look, I seem to get a lot of hard loans, and oddly enough, a lot of these condos lately are starting to get a little tougher to close too, because they're just, they're very sensitive, with the information that's provided, especially what happened over there. And I forgot what's that little neighborhood over there on the East Coast that the building fell apart. Yeah. So, I mean, they're getting tougher on that, but for people looking to buy their primary, they can't qualify with conventional loans. We have a profit and loss loan where we need a CPA to provide a 24-month history of a profit and loss, a letter plus a profit and loss to get you something. We have the bank statement loans, either 24 or 12 months, whatever is going to produce a higher average to help you qualify. That works for primaries and investment loans. Then we have the DSCR loans, which is the debt service, or DSCR loans, the debt service coverage ratio loans, where you don't have to put any income down. It's basically, based off of the rent roll and so forth, and that's strictly for investors. We also have, your fix and flip type of loans, your commercial products. So we kind of have a nice, product list, just like a big smorgasbord of all kinds of items that we're able to access, and being in the business long enough, we just kind of know what to do and what we don't want to do. Like if it's something that's out of my realm, I'll find you a good commercial lender to deal with it, or a business line of credit or something like that. If that's what you're looking
and I think
for.
you started our last conversation. I believe you started to do HELOCs also.
Yeah, actually, we do HELOCs, right? Lines of credit on primary occupancy, second homes. Okay. And there is one little niche there that we have for duplexes. All right. Only duplexes. So they do have a second mortgage that is, it's not a HELOC. They call it a HELoan. All right. So it's a second mortgage. It goes behind the first for a duplex. And with the duplex, is that they do a drive-by appraisal. So they don't even go into the property to, disturb the tenants or anything like that. They just kind of do a drive-by. And if it makes sense, then, they'll get the valuation from there. But it doesn't work for triplex or quadplex. So oddly enough, that's their only investor second loan that you can get is on a duplex.
Wow. Okay. Yeah, that is super niche.
Yeah, it is. When I saw that, because I actually had somebody that was in down in Hialeah, he's like, hey, I got a duplex, but I'm concerned if, they're going to go inside of there. And I'm like, let me find out, and sure enough, came back and they're like, no, we just do a drive-by, if the value's there and we use our value, our automated valuation system. We don't need to go into the duplex, and we'll get a second loan on it. Yeah. So that's helpful, especially if you have a low first rate mortgage. Like you don't want to ruin that, so get a second mortgage, a bit higher rate though.
Yeah, no, it makes sense. I mean, again, that's super niche. Yeah, I know some of you guys,
that's it.
You'll see, and maybe some of you guys are watching this on a recording, because all our webinars are on our YouTube channel. So in case you're watching, what we're talking about today, just so you guys know, is what's happening today. So when Jason's giving you these parameters of what the loans or lenders are asking for,
right,
it might change next week or 2 weeks.
Oh my God.
Or a month, right? Like it's constantly,
it's changing all the time. We get alerts, we get email alerts, price deterioration, or, product reduction on LTV. Like we always get those alerts, and then things get better and, you get more alerts. So we're always in the know, and, we're on the front lines, we're in the mortgage business, you're in real estate, we're in the front lines. We are directly affected by the Fed rate. We're directly affected by these markets, probably a lot sooner than anyone else is, so we are in the know and we see it all the time. And, it's just something that we got to work through. It's a different market, than it was 3 months, 8 months ago, a year ago. And so these things happen in life, and we just have to kind of like persevere and kind of fight through it. And, there's still going to be banking institutions, not like 2008 where everything got shut down. So there is still going to be work out there, and banks that are going to be making these loans and so forth. They're just going to be higher interest rates and, lower loan to values in some cases. And so we just have to get accustomed to that for a little while.
Yeah. And I know we were talking about HELOCs. People are asking investment properties. Is that possible or just?
No. Yeah, there is not a HELOC for investment properties. You know, there's primary, second homes, and then with the HELOCs, with those lines of credit that you get, you can go buy whatever you want. You want to buy an investment property, you can do that. But there is not one HELOC for an investment property. They only have it for duplexes, and it's a regular style of loan, but it's a second mortgage.
Absolutely. And I know some of you guys are asking, like, about short-term rentals. It's not really more lending questions. I've done a webinar with Antonio Lopez, who's been one of our students and has excelled in the short-term rental space. I'm probably going to do another one pretty soon with him. He's got one that, he crushes it, and we focused on his property in the past. And it's not like, an area you would think there should be an Airbnb. Right.
Oh,
so,
yeah.
When I first started thinking short-term rentals, I was thinking, it's got to be by the beach. It's got to be at this. It's got to be this mansion. It doesn't on that portion. So I think, we've had webinars because I know some people are like, how do I get started? Mm-hmm. And on those questions, I'm kind of bypassing because that's way longer a conversation. And that's really an actual webinar on what to look for and how to analyze things too. I'm going to change the subject about inflation, right? And
right.
Rates. So people are always so mad about rates, right? And some of you old timers, 8% is not much. So yes. Some of you younger people like, oh my God, it's doubled. I promise you. And if you really talk to the super old timers, like in the 80s, right? They're talking about 14% was their first mortgage.
Yeah.
And you could still do it. So it is about cash flow.
Correct.
The great thing about loans, right? If you do it right or using, the correct capital structure or debt, mm-hmm. you're pushing that inflation to the bank.
Correct.
Right. So if you really, and I'll just give you easy numbers on that, like for $100,000 and, Jason gets you a loan for $75,000, you're only worried about the inflation on your $25,000 bucks.
True.
The other $75,000, you're pushing it to the lender or the private person or whoever.
Yeah.
So once you start understanding finance and understanding numbers, it's not like a cookie cutter. Oh, the rate is this, or the rate is that, right? On that portion. And I don't know about you, Jason. I know you deal with a lot of investors, obviously with the club. I know tons of investors. Most of my investors, they all have leverage.
Good.
I don't really, I know sometimes, the idea and that's a different kind of conversation. I know sometimes, hey, I want to own all these free and clear. I got it for peace of mind. I got it on actual cash flow and what your purchasing power. It's a bad decision. You're not hedged to inflation.
Yeah.
So it's one of those things that's out there, right? And if you don't know some of these creative financing things webinars that I've done with Taryn, and we're doing subject to, right? We're taking over, loans and that end of it too. And I'm not gonna put Jason on the spot too. The other reason why I like Jason so much is he focuses on investors. He's an investor himself.
Thank you.
I'm just gonna say a general thing.
Sure.
Jason recently did a flip,
right?
For about $40,000 or $50,000.
Somewhere around there, yeah.
Somewhere around there. So he feels your pain as an investor. He's not a cookie cutter mortgage guy on that portion. So I just want to make that. I don't know how to, because sometimes you have, I'll talk about accountants.
Right.
Like some of the CPAs, they're not real estate investors. So some of the advice I see, not good.
Right.
They don't understand that, right? I'm working with the NFL players, some of these professional athletes. Their financial planner is telling them one thing, and I'm like, that's not really
how it works.
No.
Yeah.
On that
so
end.
You're in the game, and you understand it. And that's kind of how I am too. I understand it from your point of view, what you want to do. I know how to navigate through those fields and so forth. And yeah, definitely, I appreciate that, because that's something that is maybe different or unique about me, because I'm kind of part of the club that way, I want to invest in more properties. I gotta find more time for it, but there's definitely a lot of opportunity out there,
And this is the other reason why I have Jason on too, is even though I'm licensed in mortgages, I'm not in it, right? So when people ask me, right, it's easy, Jason and I chatted about this. That's why we're actually doing this webinar. I was like, there is no way I'm going to be able to regurgitate, all the things that Jason said, and I'm not going to remember this and that portion of it, right? And it, I'm going to add it's about community. Being part of the RIA. Jason asked me about that flip. He had some questions. What do you think I should do about this? I got questions on the accounting side or my retirement account. I'm making a quick call, or an attorney. What about this? Or violations. So the idea of you being able to do all this by yourself, you could. It's just going to be a lot slower, right? And there's chances of minefields on that portion. And we talk about that's why you want to build your power team on that portion so that you could actually understand this. And you're going to get good at your craft, because a lot of people ask, like, and I'm seeing things, hey, how do I get started? Right. One of the things is, if you're not a member of RIAFAX, right? We've done webinars with Francisco. He actually has an Airbnb feature.
Nice.
Right? So you could actually, which I don't know if you know this, Jason, that you could actually find listed properties and it actually breaks it down on potential equity. And as like, hey, this might be a good Airbnb for you. So we've actually done
that's awesome.
A webinar with Francisco. So that's on our YouTube channel, and I'll have to have him come back. So it's just one of those things that you're out there. And Francisco is the owner of RIAFAX, by the way. So just in case you guys don't know, but he's also local too, right? He lives in
Super
Pembroke
nice
Pines.
guy. Yeah. That's what's great. You got a lot of local people here that are, built into the fabric of the community, and that's what's important. But yeah, Francisco's a very sharp guy. I've known him for a long time.
Yeah. And the funny part, that Airbnb feature came out of our boot camp. Someone asked him, he said, no one ever asked me that. Sure, no problem. I could do that.
You built it. Nice.
We're, as a group, it's pretty big. And so you're going to need all these pieces, right, on that portion. Again, if you're new to this and you got properties, I'm buying properties, right? We have a co-wholesaling side too. We have a 10,000 plus cash buyers list. So I just think that, I don't know, like, and I did a market update on Tuesday with Ben Moss and Chris Kennedy. And, he does multifamily, and, Ben does luxury, and like, we're pretty bullish on what's happening. Like, I know, like, the doom and gloom, I feel like sometimes I'm watching TV on the economics. It's not bad where we're at. Right. So you can't clump everything together. So our price is going down a little bit. Yeah, but you're still up 27-30% this year.
Right. You're right. I see a lot of homeowners that maybe missed the boat on that, and then there's some homeowners out there that are still getting over list price. I mean, it just depends on the house itself and what people are willing to pay for, but yeah, I do see that happening out there. I see the appraisals are strong. I just had
and Tony, one of our students, he got I think 5,000 to 8,000 over a list price.
Oh wow, nice.
And all the appraisals hit, right? So in that workforce market, right? Again, it all depends, right? There's luxury, high end, condos, the workforce place is different, right? And that when I say workforce, I'm saying, first time home buyers, their initial homes, it's still better than.
I think the first time home buyers are going to have a good opportunity in 2023. And I think from what I'm seeing is, a lot more seller credits out there. Seller credits that pay for closing costs, seller credits that pay for discount points, that 300, 400K area, 450K area, like there's a lot of wiggle room there, if a property is not perfect, I think the first time home buyers will have a better time in 2023. It's just going to take some time to kind of like, readjust. Let's put it that way,
Absolutely.
So
do you have and I've heard these, I'm not sure if you do them. If you guys have been watching our webinars, I have no problem asking our guests, and I put them on the spot. Sometimes they do. Are you doing those hero loans? Like sometimes I've heard about like firefighters, police officers.
The hero loans are something we haven't done too many of those. We're on the more or less a broker channel, but we send them out to a direct lender to handle those. And oddly enough, I did speak to that gentleman today, and the hero loans are priced a little differently. So what happens there is that you're not getting, if your FHA rate is 6.5 or something like that, then you might be at like 7.1 or something like that. So they're priced a little bit differently, but they are out there, and they're good loans for our EMT, our firemen, policemen, and the heroes that we have in the community that really help us out. I just, think Dade Broward County is a little bit tough, and taxes, insurance, so it's a
You know,
little tough to get qualified for some of those things.
what's funny is like I know we've been talking about those things. Do you want to talk about what the new conventional and FHA limits are? I know we didn't even talk about that.
Yeah, I mean, oddly enough, FHA limits are at 460. They're kind of right there right now. They've been there this whole time. You could purchase a home for about 475, put down 3.5%, get a nice $460,000 loan. I mean, I say nice because it's, it's a big loan still. But with conventional, some lenders are bumping it up, because they came out with some information, right? Currently it's at 647, I think 500 or 400. And they're probably going to be dipping their toes into the 715, 700 range. So what I'm seeing is certain lenders are taking those loans in now. Let's say for example, Rocket Mortgage, they're taking the 715 loan in right now. And then there's other lenders that are taking it around 700, so until 2023 rolls out, we don't really know exactly what it's going to be. But yeah, I mean, pushing those loan limits up is helpful, but it's also in a good indication that there are certain areas of the country that are expensive, and we're in it right here.
Absolutely.
Cat's out of the bag about South Florida. Everybody loves it. No,
absolutely. Are you seeing? I mean, it's unfortunate, obviously, what happened to our brothers and sisters on the West Coast here in Southwest.
Oh, yeah.
What we were talking about, which it didn't even dawn on me, which I thought was pretty interesting, was that the other experts I had, they said they're starting to see a migration from the other sides coming here was number one. And the other thing that they were talking about, the snowbirds were actually looking for short-term rentals instead of them usually picking that side. Now they're picking this side.
Wow, that's great.
Was kind of, what the other experts I was talking to, I was like, wow, like it didn't even dawn on me, right? So if you want to get into that short-term rental business, I mean, there's a lot of opportunity out there.
Sure.
And actually, since I have so many people on this webinar, if you put in a chat, would you guys be interested if I do a one-day event with like Antonio just on short-term rentals, like a paid event? Because I'm trying to close out the year and try to figure out what we're gonna do on the topics that you guys like, not the topics that I like, or Jason likes, or other mentors. And it's just that we're as a RIA, we're just adapting to what you guys need. Like that's my job. Owning the RIA is saying like, hey, this is what we want to hear. This is what's out there on that portion. Okay. Yeah, I see a bunch of yeses too. So
yeah, I mean, like to answer your question, yeah, I mean, I haven't seen the migration of people coming over for purchases. I still think it's fresh. Probably rentals are going to be the way it's going to go. Because it's. I mean, look, these people may have lost their homes, may not be working, they may not have the income coming in right now. So I think the rental market's going to outpace obviously the purchase market, because it's expensive to live over here on the East Coast versus the West Coast. So we'll see. Maybe they come on over here a little bit later, but hopefully they can turn that place around quickly and get it back up to speed. It's a good little part of Florida.
Yeah, absolutely. And so we're almost out of time, and I know someone won $100.
Nice.
They're gonna be very someone got paid to listen to us. Look at that.
That's pretty cool.
Yeah,
that's nice.
Look at that.
I have a winner. So drum roll.
All right, here we go.
Our winner for today's raffle is Michael A, like Alexa. And we have about 4 Michaels in this webinar right now, so I don't want you guys to get confused. Michael A, you know who you are. Yeah. He's been around for a while. He always comes to all of our events. Michael A.
Michael A, I'm coming for you. I'll give you my address. I'll give you my wish list on Amazon Prime right now, and feel free. No, I'm kidding.
Seriously, Michael, I'll see you on November 2nd with my goodie bag. No, I'm just kidding. No, just kidding. But yes, congratulations. And thank you, Jason, for your generosity.
No problem. Thank you.
Oh my gosh.
Jason, any last, so a couple of things, just so you guys know, Jason's information, I know Alexa's been putting it throughout the chat. It is also on our website too. I think if I'm correct, like your link, if they go to their website where if they just want to get approved or something like that, do you have something like, hey, I want, or do you want them to hit you up first on a scenario, or
Yeah, I mean, look, you can reach me on my cell phone. I'm always picking up my phone, which is probably annoying to a lot of people, but you know.
So wait, all right, guys, you guys got to help me out on this, right? I love Jason to death, right? He's got kids, he's got a family, he's got clients. Please do not bombard his cell phone with just general questions, because he will not come back.
No, that's not true.
No, but like,
I mean, look,
what I would say,
questions business.
Yeah, if you had scenarios too, I just think it's easier with email on that portion too.
It's easier to track on email.
Yeah.
Like a lot of people like the texting and all that stuff and the WhatsApp, but for me, it's just easier to track emails. It's just easier that way to track them.
Yeah, I have the same problem. So that's why I tell people the same thing. Put it in an email. We could go back, because again, remember, he has a lot of clients. He's talking to a lot of people. It's hard to remember as you get older, you know, who you talk to, what you say, or
my iPhone only has like 9 buttons where I can pin it to the top for favorites. I wish iPhone would change that and put like a list, you know, so I can put like 20 or 30. But yeah, I mean, emailing me, if you have a general question, you need to text me, that's fine too. You know, I'm okay for that.
Thank you so much, Jason. Thank you guys all for being on here. Everyone, you all know this replay will be on the YouTube channel in a couple days. Awesome. I will also be sending you all a thank you email today with Jason's information, which again, you can find on our website right now if you don't want to wait for my thank you email everyone. In a couple minutes.
Thanks for listening.
But absolutely. Oh my gosh, so many questions, guys. I know we missed a bunch of questions here, but we went through so many questions, probably about 30 questions. A lot of you in here are new, and we're happy that you're here. What I can say to you is keep coming back. You're in the right place. So any new investors in here, you know, you're doing the right thing. You're getting connected with your local RIA. That's exactly what you should be doing. And look out for the thank you email from me. You'll get it in your inbox probably within the next 10 minutes. Alexa@bpmria.com. So maybe double check spam, junk, all that good stuff, because you will all get an email from me.
Yeah, and so just a couple of little other things also. There'll be a link for a 5-star Google review. Nice. We really appreciate if you give us a 5-star, whether it's about our organization, about Jason, you know, or maybe it's just about Alexa, not about me. It doesn't matter. Give us 5 stars. It's just a good way to, you know, start really building our community. A lot of you guys are on our email list too. So you might, and if you're members, you might be getting we call it a video ask. So we're looking for testimonials about our organization, whether, you know, you're a student, you're a corporate member, individual member, or you're doing just coming to the meetings. Our goal is to really build this community. The bigger we build this community, the stronger we are in general as a team. And we get to add on more experts, and we get to do these webinars for free. And it makes it fun, and it's a learning experience for all of us too. So again, thank you so much. And for a change, we finished on time.
There you go. Good. Awesome. Good job, Anish.
We're getting better. It's on our first day. And if you really want to meet Jason, he will be at our November 2nd meeting. He does have legs and feet and all the above on that portion. So come out, and you know, we'll have a great topic too. And that's what the networking is about. And you'll also meet some other great vendors that are part of our team too. So
awesome.
Thank you, Jason.
Thank you, Anish. Thank you, Alexa. And thank you, everybody, for listening.
Thank you, guys.
Take care, guys.
Awesome day, guys. Bye.